and welcome to today's How's It Going sessions brought to you jointly by ORIMS and Sedgwick with the support of RIMS Canada. I'm Debbie Carpenter, your ORIMS Professional Development Director for the 2020-2021 term. And so far, what a year it's been. As risk professionals, there are a number of shared challenges that impact our work, and we'll look at three of them today. Macroeconomics and the insurance marketplace, our service environment, and navigating this unfamiliar new normal. Before we delve into these sessions, RIMS Ontario Chapter President Tanya Dietrich has a few words. Tanya?
Thank you, Debbie, and good day, everyone. We are so pleased that you're joining us today for this informative event. As much as we would have liked to have been speaking to you in person, ORIMS is absolutely honored to host this virtual event and bring it to a wider audience right across Canada. We have pre-recorded the sessions to ensure that there are no technical difficulties. However, our speakers have agreed to participate in a live Q&A after each of their sessions. We ask that you not record the event, as we will provide a copy on our website. I would like to acknowledge our partners for this event, Sedgwick and RIMS Canada. Thank you for helping us put this together. We chose this date in recognition that exactly 1 year from now, we hope to all be together again at the rescheduled RIMS Canada conference in Ottawa. On that note, I present to you our RCC Chair, Jeanette Demers.
Thank you, Tanya. Yes, sadly, no Canadian RIMS conference in person this year, but we do cross our fingers, like Tanya said, that this is just temporary. So first off, I welcome you from across Canada to today's mini conference, bringing you a different perspective about COVID and its impacts on our industry. I want to thank our guest speakers for their time, and I especially want to thank the Ontario chapter and Sedgwick for this initiative in bringing our community together. Special thanks go to Debbie Carpenter, Tanya Dietrich, Tina Gardner, and Gary Gardner for the organization. And on this note, I'm brief. Enjoy your sessions. Gary, I invite you now to say a few words to our audience.
Thank you very much, Jeanette. And on behalf of Sedgwick Canada, thank you very much for this opportunity. And thank you all for being here. I would much rather be seeing you face to face in Ottawa, so let's hope next year we get that opportunity. Today, we have a number of terrific sessions. We hope you find them of value. And as RIMS Canada has done in the past, a local charity was chosen in Ottawa. And I'm happy to announce, as we do today, nowadays, I don't have a check to hand to you, but I can tell you a digital donation has been made to the Ottawa Mission Foundation. This group has been providing services to the Ottawa community for well over 100 years. I've had a chance to get to know them over the last couple of weeks. It's truly a remarkable organization and a great choice. So with that, happy Thanksgiving. Please stay safe, and I'm going to turn it over to Dan.
Thank you, Gary. Yes, the Ottawa Mission certainly does a lot of good work in our community. Our chapter has been supporting them for a number of years. They've been deeply impacted by COVID-19, and the donation will be greatly appreciated by many in the community. Thank you very much. For the audience, would invite you to stay at the end for the closing remarks. We'll have a little surprise for you. And over to Debbie.
And without further ado, let's get into our first session titled, How Are They Doing? A peek into the insurance market in 2021 and beyond. Our panel consists of Lynn Oldfield, President and CEO of AIG Canada, Sarah Robson, President and CEO of Marsh Canada, and Heather Legg, Chief Agent for Validus Reinsurance Limited Canadian Branch. Our moderator is Catherine E. Dowdall, Director of Risk and Insurance at Aecon.
Welcome to RIMS Canada virtual session called How Are They Doing? A peek into the insurance market in 2021 and beyond. My name is Catherine Dowdall, Director, Insurance and Loss Control, Aecon Group Inc., based out of Toronto, but like most of you who have been working from home for the last number of months, I am now based out of my guest bedroom. I will be your moderator for today's session, and I was honored to be asked to work with such an esteemed panel of insurance industry leaders. Speaking for myself, this past year has most definitely been a challenging one, not only because of the pandemic, but also because the current insurance marketplace is in flux. I will leave it up to our speakers to put a name to what we are experiencing. Our speakers will look into their crystal balls to help us navigate these very interesting times and to provide us with their insights as to what we may expect in the next year and beyond. All of you would have received the bios for our speakers, and rather than read those to you, we thought we would share some personal and interesting facts about them. Our first speaker is Sarah Robson, President and CEO of Marsh Canada. Sarah is a Queen's grad, and during her 4th year, she was trying to figure out what path to follow with respect to a career. What to do, go to law school or do an MBA. But she decided maybe it would be best to get some business experience. She had a day full of interviews with Chubb Insurance, and they asked her to meet with one of their executives. And for any of you who have been in the business as long as I have, you will recognize the name Udo Nixdorf. He led their executive protection and financial institutions department in Canada and was regarded as Canada's statesman for D&O insurance. That interview went very well, and the next day they offered Sarah a position as an underwriter in the executive protection department, underwriting financial lines, and as they say, the rest is history. Sarah did write her LSATs, but never gave another thought to law or an MBA degree. She continues to be excited every day about her career choice. Our second speaker is Heather Legg, Chief Agent of Validus Re Canada. Heather started her career at the ripe old age of 7. Yes, I said 7. Taking calls from farmers about their cows getting loose. You see, her dad was the general manager for a small farm mutual, and their house phone number was the after-hours claims hotline. Our final speaker is Lynn Oldfield, President and CEO of AIG Canada. Lynn joined the insurance industry as a Wilfrid Laurier University co-op student in the 2nd year of the program. Little did she know at the time the opportunities that this industry would create. She has had the pleasure of world travel, attending glamorous events at RIMS conferences, and meeting many famous people. Warren Buffett was a career highlight. Lynn has been paying it forward by hiring Wilfrid Laurier co-op students since she joined AIG in 1991. I would now turn it over to Sarah to begin our presentation.
Thank you, Catherine. It's great to connect virtually with so many members of the Canadian risk management community. I'm sad that we were not able to come together in Ottawa in September, but I'm looking forward to seeing you all 1 year from now and hopefully sooner. I hope all of you and your loved ones are staying safe and healthy during these unprecedented times. 2020 has been quite a year, and as we look forward to 2021, it appears that many of the factors we are facing today will continue well into next year. So I want to start by talking a little bit about where we are today. In the second quarter of 2020, global commercial insurance prices rose by 19%. This marked the 11th consecutive quarter of price increases, tracked by Marsh's Global Insurance Market Index. Overall, underwriters continue to push for higher levels of pricing increases due to the combined effects of social inflation pressures, persistently low yields, and a number of large underwriting losses, including from COVID-19. While capital remains adequate in most lines, insurers' risk appetite is reduced as they are increasingly cautious in an uncertain environment. When we look at specific coverage lines on a global basis, we see property insurance pricing increased by 19% globally, casualty pricing increased by 7%, and financial and professional liability rose by 37%. In Canada, we are experiencing many of the same trends and conditions that countries around the world are facing to varying degrees. During the second quarter of 2020, underwriting discipline has continued to drive premium increases. We are seeing increases in the range of 20 to 25% on average for property placements and approaching 20% for liability placements. We are seeing higher rate increases in Canada compared to the global averages, primarily due to the previous low sustained premium rates and high levels of insurer competition. Due to pressure from shareholders and reinsurers, insurers continue to restrict the level of capital that they provide and reduce volatility by managing their overall exposure to individual clients, market segments, and geographies in order to reduce their own volatility. Property markets are beginning to move away from writing accounts on a total insured or TIV basis. This is specifically relevant for clients who have been purchasing policy limits in excess of 150 million. So if that is the current state of the insurance market, what lies ahead? The remainder of 2020 and 2021 presents several potential headwinds that could accelerate property and casualty price increases. There's the continued uncertainty around known business interruption or BI losses. Insurers are closely monitoring ongoing regulatory and legal proceedings in the UK as well as other jurisdictions. In May, the Financial Conduct Authority in the UK, or otherwise known as the FCA, announced that it would commence court proceedings to test how certain business interruption insurance policies respond to claims arising from COVID-19. The purpose of the court proceedings was to clarify how certain business interruption policies and wordings should be interpreted and whether they cover losses arising from the COVID-19 pandemic. We learned the court's decision last month. It found in favor of the arguments advanced for policyholders by the FCA on the majority of the key issues under consideration. Appeals will follow in due course, with further implications for in-scope claims. And the English High Court judgment, it should be remembered, applies only to policies governed by English law. That said, the court's judgment may very well influence insurers as well as local courts in other jurisdictions. There's also potential for COVID-19 linked employers and public liability claims at a time when casualty insurers are already concerned about the adequacy of non-COVID-19 claims reserves. The second is the impact of catastrophe losses, including the recent wildfires and the 2020 Atlantic hurricane season, which officially ends in November. Extreme weather conditions have fueled the growth of numerous forest fires in the western United States, as well as the ignition and spread of several new fires. Much of California and the Pacific Northwest remain under red flag warnings due to high temperatures and windy conditions. The statistics may be deceiving, as the US has experienced only 82% of normal acreage burned this year. In a typical year, nearly half of the national annual acreage burned is driven by wildland fires in Alaska. This year, however, was very quiet in terms of fire activity in Alaska, with the majority of activity concentrated in the western US. On the hurricane front, we expected a busy season in 2020, and this has proven to be true. So far this year, we're setting records with 23 named storms, 8 hurricanes, and 2 major hurricanes. We've also seen the earliest S-named storm since the practice of naming storms began in 1950. That was Sally. Since then, we've had Teddy, and we've also had tropical storms Vicky, Wilfred, Alpha, and Beta. The impact is significant loss numbers coming into the industry. These are currently developing, but many industry sources are estimating the losses to date this year are around $25 billion US. An added complication this year is the challenge of preparing and responding to a storm in the midst of the COVID-19 pandemic. We expect that the current low interest rate environment will also continue into 2021, which will not help insurers' profitability. Rate increases are not yet at the level needed to support the current interest rate environment. Another potential headwind is the P&C reinsurance treaty renewal season in January 2021. This is the time when many global insurers renew their treaty or portfolio reinsurance. Pricing in the direct market has increased quarter over quarter through 2020, despite many P&C treaties renewing at modest single-digit rate increases in January. Some insurers that arranged their main treaty renewal earlier in the year have reported double-digit increases for both P&C treaties. Insurer results for the first half of 2020 vary, but many insurers are reporting combined ratios, that is the ratio of incurred claims and expenses, including reinsurance treaty costs, to earned premiums in excess of 100%. We therefore anticipate that insurers will immediately pass on increased reinsurance costs to direct policyholders as they seek to achieve profitable underwriting results. Heather is going to speak in greater detail about the reinsurance market. The other thing to consider is the Lloyd's of London marketplace. Lloyd's is a real factor for us in Canada, and it is facing its own challenges right now with the impact of its profitability review of the bottom 10% of its syndicates and the dynamics of how it is treating growth within other syndicates. So what does this all mean for you? To successfully navigate a changing insurance marketplace like the one we are facing, it is important for organizations and their risk managers to be prepared. We recommend our clients focus on a few key strategies. Start the process early. It takes significantly longer to complete the marketing of any risk than it has in the last 10 years. Take time to identify and understand your risk appetite. Increasing retentions, reducing limits, and redefining cover are options that will provide robust rationale for underwriters to reduce their pricing. We recommend being proactive and controlling the range of options based on your risk appetite and tolerance, rather than waiting for insurers to impose changes. Prepare a high-quality underwriting submission and presentation. Focus on up-to-date risk information, but also on industry trends and risk differentiation. Understand your claims and articulate the lessons learned. Reflect on your response to large losses and changes in process to mitigate future claims. Ensure that claims management protocols are established to convey oversight and control of claims. Focus on risk management. Spend time on insurer engagement to articulate risk quality and provide up-to-date information on achievements as well as future plans. Have a thorough market engagement plan. Include potential use of our international hubs in order to generate capacity and create competition. Involve the C-suite. Engage with insurers' senior leadership and also involve your own senior management in order to articulate the board-level approach to risk management and enhance accountability. Market the program effectively. Ensure that insurers have the right risk information and timely engagement. It is also helpful to look through a cross-class lens and consider the premium volume placed across all lines with each insurer. And stick to agreed milestones in order to maintain control. The level of activity in the insurance market has intensified and marketing is taking longer. Staying on top of the timeline and using time to your advantage is crucial in order to proactively manage marketing results. At Marsh, we work with our clients to help them achieve certainty in the renewal process. Our job is to ensure our clients have choice and options. They may be challenging to accept in this environment, but you will have options. If I could leave you with a little advice today, it would be to start early and don't count on extensions. Have a well-prepared placement strategy and assess your organization's risk appetite prior to entering the market to ensure that you as the customer continue to drive your choices and options for insurance. You'll be limiting your options if you're reliant on an extension. We have seen options taken off the table after an extension is granted. As we all know, liquidity is very important for all of our companies right now, insurers included. On that note, I'll leave you with one final thought. This might be the year to also consider premium financing. I look forward to continuing this discussion during our Q&A session. Thank you, and I'll now turn it over to Heather Legg to discuss the reinsurance market. Heather?
Thanks, Sarah. Thanks for inviting me. I've been told that reinsurers are to blame for increasing rates. Well, as Sarah outlined, we aren't the only culprit, but I'm happy to have this opportunity to have a conversation about why reinsurance rates are likely to increase this year. Sarah gave you a quote from Moody's. Well, I'm sure you've seen some of these headlines during the last month or so by reinsurance executives. A few of my favorites are more rate needed, price increase is absolutely essential. Okay, you could argue that these quotes are reinsurers posturing in advance of the January 1 renewals, but does that mean it's fake news? On one hand, you're probably right, but this year, even the reinsurance brokers are joining in. The definitive, we will see higher pricing at 1 January in property. So let's take a look at the challenges and hopefully make sense of why these headlines are not fake news. Over the course of the next 10 minutes or so, I'll give you a high-level overview of loss activity both globally and in Canada, and hopefully not duplicate what Sarah has already highlighted. We'll also talk about available capital, including new entrants and ILF, and retro protection, and I'll explain those in a little bit more detail, and also discuss the global nature of reinsurance and why that's important. But before we get too far, I'm going to give you a very brief reinsurance primer. So you are all smart risk managers, of course, and you buy insurance for your home, your car, as well as the corporation that you work for. For illustrative purposes, let's assume that you all buy your property insurance from the same insurance company. Well, of course, that insurance company therefore has a fantastic portfolio of property risks, which any reinsurer would happily support. Well, the Canadian regulator tells that insurance company that they need to protect their property portfolio against the 1 in 500-year catastrophe, which seems prudent. So some smart people sit down and use models to calculate what that big loss looks like, the one that's only going to happen every 500 years. In our example, the 500-year probable maximum loss, or PML, is $1 billion. So the insurance company says that they can retain the first $100 million of each cat loss, so they decide to buy reinsurance excess of that amount for $900 million. Now, for a $900 million program, one reinsurer won't take all of that risk, so it gets shared, and the program gets structured to enable that sharing. Some reinsurers like the bottom end, where there is more risk, but also more money, and some prefer the top end, where the likelihood of loss is supposedly only 1 in 500 years, so they charge maybe only 2% of the limit that they are providing, and that's referred to as rate on line. For a $900 million program, you probably have about 30 to 50 different reinsurers taking a small share each, helping to spread the risk. The risk will also be spread geographically. For a program like this, you would normally place the treaty a third with Canadian reinsurers, perhaps a third in London, and then maybe a third in Bermuda and Europe and elsewhere around the world. So when losses happen, your home, your car, and your business get supported by all of these companies. And speaking of losses, 2020 is no walk in the park for this industry, unless it's this park. Sarah's already spoken to the wildfires. Historic wildfire outbreaks have been ongoing in the US since mid-August. For Canada, thankfully, we've had one of the quietest wildfire seasons since the 1990s. And then, of course, the hyperactive hurricane season. As Sarah mentioned, we ran out of storm names a few weeks ago, forcing the use of the Greek alphabet, which is only the second time since the 1950s. Hurricane Beta was the 9th named storm to make landfall in continental US in 2020, and that ties a record set in 1916. And sea surface temperatures across the Atlantic remain conducive to more storm formations during this year's hurricane season, so that's not great news. Of course, the riots. The vandalism and looting following the death of George Floyd will cost the insurance industry more than any other violent demonstration in recent history. Within the first half of 2020, I think Sarah had mentioned a number of 25 billion. The global insured cat loss number that I came across was 31 billion. Either way, it's high, 13% above the long-term average. Now, this industry, the reinsurance industry, can handle 1 year. That's what we're designed for. But this is on top of 3 years of heightened natural cat losses: hurricanes Irma, Maria, Florence, Michael, Dorian, Japanese typhoons, Trami, Jebi, Hagibis, Faxai. Of course, the Wolseley and Camp Fires in California, as well as the wildfires in Australia last year. Years of losses add pressure to reestablish profitability. Now, you could argue that we live in Canada, so let's look at Canada specifically. During 2020, we have experienced bomb cyclones, ice jamming to multiple hailstorms, including the June Calgary hailstorm, which will be the 4th largest cat loss in Canada's history. Not to leave out hurricanes, my slide picture is of Tropical Storm Teddy, just about to hit Nova Scotia a few weeks ago. It looks bad, but thankfully, while the storm brought very high waves, strong winds, and heavy rainfall, which definitely disrupted people's lives, it does not appear that there will be a major loss. But it's yet to be seen. And it's yet to be seen how these losses are going to be shared between insurers and reinsurers. One industry executive suggested that the reinsured losses will be around 700 million. And to keep that into perspective, the total reinsurance premium in Canada is around 2.8 billion a year. And a third of that is generally for catastrophe reinsurance programs. So not a great year, regardless. And unfortunately, 2020 is not an isolated year. Similar to the global experience, Canada has been repeatedly hit with large cat losses. Thanks to my friends at Aecon Reinsurance Solutions, I've borrowed this chart which tracks the total insured cat losses in Canada over 30 years. We used to be able to say that total cat losses were typically around 1 billion in Canada a year, but clearly this trend is increasing. And if you include 2020, there are 5 years with losses over 2 billion, and 4 of those have been in the last decade. In order to pay for losses and support writing business, the industry needs capital, of course, but also a healthy return to attract and retain that capital. According to Willis, global reinsurance capital declined 3% in the first half of the year. Now, of course, this masks the 30% hit to capital at the end of the first quarter, but equity fluctuations aside, the low interest rate environment that Sarah has already touched on is another factor altogether, and one that won't be going away quickly. So similar to Willis, and also tracks the global capital available within the reinsurance community, and noted that for the first half of this year, there was an overall return on equity of negative 1.5%. Sarah mentioned the combined ratio being over 100, and I believe the number's around 104%. So, you know, that's not great. So why does the capital even stick around? Well, because it's of the potential to improve that return through a hardening market. So of course, that's going to attract new capital, which you could argue could have a countering effect. However, in previous hard markets, the resulting new flow of capital followed significant losses, which had eroded that capital. Case in point is Validus. We were established following Katrina, Wilma, and Rita in 2005. The difference this time is that there is plenty of capital in the market. So while the market conditions are attracting new capital, it is really not expected that there will be a dampening effect on the rate momentum. And when we talk about capital, we are including both traditional capital provided by reinsurance companies, but there's also capital provided by third-party investors who are looking for diversification through what is called insurance-linked securities, or ILS for short. A cat bond, which I'm sure you've heard of, is a form of ILS. And by the way, you are all investors in ILS, since the Canada Pension Plan has been investing in this space since 2011. So the way this capital works is that the investors commit a chunk of money to an underwriting year. And at the end of that year, the money is either used to pay for losses or goes back to the investor. And that investor can then decide to keep that money or redeploy it into the next underwriting year. The problem is all those losses. And those losses are taking long to close out, what we now call longer tail, short tail losses. As an example, the Japanese typhoons in the last few years have taken much longer than usual to finalize. I'll use Typhoon Jebi as an example. Originally, it was estimated at 3 to 5 billion, but it grew to 16 billion over a few years. Osaka had been hit by 4 typhoons, a flood, and an earthquake over the span of 5 months. So that led to a volume of claims that they just weren't prepared for, and challenges to determine which event had caused the loss. And on top of that, there were contractor shortages due to the upcoming Olympics. So while all of this is happening, the investors' money is in limbo. They can't redeploy it to the next year. And this is what is called trapped capital, hence my trapped cat picture. After 2 to 3 years of trapped capital, the investors are less enthusiastic with this class. So the trapping of capital within the ILS market is also having an impact on reinsurers' ability to buy their own reinsurance protection, what is called retrocessional reinsurance, or retro for short. As ILS capacity has been trapped, the remaining available retro capacity has become more expensive. So average rates at last January were typically up 25%. For 2021, early predictions are again for rates to be up 15 to 25%. So this increase in retro costs will have an impact on the capacity that reinsurers are able to offer insurance companies. Effectively, in order to maintain the same net positions, reinsurers have reduced their gross lines to coincide with that reduced capacity. So what does all this mean for Canada? In my days of being a reinsurance broker, we argued that Canadian clients should be judged based on Canadian experience. And to be fair, for non-cat lines like casualty and property per risk, reinsurance renewal pricing will definitely be more influenced by the insurance company's own loss experience and underwriting. But when it comes to catastrophe reinsurance, the view has to be global. There's $590 billion of reinsurance capital globally, but only 0.4% of that is in Canada. The Canadian insurance market is supported by global reinsurers, particularly on the cat side. And those companies, the Canadian reinsurance companies, are really just branches or subsidiaries of global companies. Validus is number 26 in the list of global reinsurers, and yet we have offices around the world to support a global portfolio. In order to retain the necessary capital to keep the whole insurance industry working, including the amazing clients that are ultimately insured, we need to work towards long-term financial stability. As a reinsurer, we're a little bit removed from the front lines where you may all be feeling the brunt of rate increases and coverage decreases. So thank you for the opportunity to share the reinsurer's perspective. I hoped that helped. And now I'll pass it along to Lynn. Thank you.
Thanks very much, Heather. Well, I'm in the fortunate position of batting cleanup this afternoon, so I'm going to cover off some of the emerging risks. Sarah and Heather have done a great job in walking you through sort of the current environment and thankfully speaking on behalf of the many insurers on your program and some of the challenges facing them. But let me just try and put it all together for you from an insurer perspective. So, you know, we've talked about the global pandemic and its impact, but I think Sarah and Heather also laid out very, very nicely that there have been increasing claim costs. So talk about loss trends and increasing claims, plus the Nat Cat situation, both globally and in Canada that Heather outlined. Overlay that with a global pandemic, and I think you've got a really challenging time in the Canadian market. We are dependent upon global reinsurance support. So as different carriers look through their portfolio to get to sustained profitability, it's in a low interest rate environment, and that means some shift. And Sarah's advice is the best advice. Get out in front of it. You may need more players to fill out your subscription or your excess layers, and they may be looking at different areas of focus, either moving up in your tower, moving down, or structuring things a little bit differently. And it's all going to be individually driven by those component pieces. The secondary or indirect impact of everything that has gone on in 2020 is really the economic impact. And that's where we're spending a tremendous amount of time working with our clients. And I tend to follow Tiff Macklin, the governor of the Bank of Canada. I think he gives us good economic insight, but they're concerned about the economy. We're definitely in an official recession here in Canada, and that's anticipated to flow through 2021. So moving on to globalization. So many of your organizations have footprints or sales in different places around the world. And just one of the trends that we pay attention to within our multinational space is globalization, but also change in trade. And many of you are looking at alternative or captive type arrangements right now. That's one of the responses to the current market. Make sure you bake in some of that guidance up front, because the rules of engagement are moving in country and we're helping contain that. But your supply chain, this is one place where, oh, Sarah was bang on, get out in front of your renewal. But I'm going to go one step further. I'm going to actually say many of our clients are kind of peeling back and looking at a blank page as they assess their risk and as they build up. They're building up their real estate values. They're looking at the current economic impact. They're taking another look at their revenue forecast. And when it comes to supply chain, we're very used to, in risk management, corporate Canada, planning out emergency preparedness, business continuity, and also structural and time-related plans. So this is a really good time to get with your procurement team and just make sure that the supply chain, that you fully understand the when and the where, some of the time element, and those of you who work in big industry, large construction, Catherine, know that some of these component parts come from far, far away and take a long time to get through. So another emerging risk is innovation and technology. We're shifting all over. What I can tell you is at the top of the list of our concerns, and our growing concern on your behalf, is cybersecurity. But if one piece of advice, keep your cybersecurity very diligent with your employees. Make it fun. Make October and November Cybersecurity Month. You want to make sure your carriers have all the resources available to you, and a heightened risk that I need to draw to your attention. So the next one is really social inflation, and both Sarah and Heather talked about those long tail liability lines, but I'm going to overlay social inflation. We call them nuclear awards. We call them increased and heightened court attention. You might think because there are no jury trials right now, because we've gone to online mediation and just judge trials in some jurisdictions, that would bring down the awards. And then finally, the emerging risk that I believe personally, and this is now my view, and I've spent a lot of time on this one, is sustainability and climate change. Back to the Marsh Zurich report at the World Economic Forum and the global risks. For the first time, the global risk register was dominated by climate related. Heather didn't get into the nitty gritty of the science, but I think as risk professionals, we have to be believers. And so you're seeing increased nat cat activity. You're seeing a real focus, depending upon your organization's place, whether you're publicly traded, but certainly Alberta is spending an inordinate amount of time presenting to the investor community exactly what their carbon footprint is and the path to carbon neutral. And that's one area where I would really guide our risk management professionals: get educated, get engaged, make sure you're contributing to the conversation in your organization. And it's a big one. We are going to talk about sustainability for a long time to come. So Catherine, I'm sure we've got some questions. I'm going to pass it right back over to you.
Thank you, Lynn. Thank you, Sarah, Heather, and Lynn, for your very informative comments and your practical advice. We would now welcome any questions that our audience may have.
So I have a question. So I'm in an industry that already had very few markets available to me, and that market is shrinking even more. Some of the municipalities don't have the capacity to take on much more higher retentions than they already are. They may be forced to, I understand that. We don't have the option of having a pool. That was experimented with the reciprocal, and it failed. And I'm not sure that there's an appetite to resuscitate that. So Sarah, you gave lots of tips about how to approach the market, but I'm looking for some advice on how to, as an industry, perhaps lobby the marketplace to see if we can't get more interest, whether that's some kind of structure, lots of layering, but we can't go without. We're almost to the point now of the position we were in the 80s with the liability crisis, and municipalities just can't go without insurance. So it is a personal question, and it's probably got multiple layers, but I'm just looking for some quick overview of, is there a lobbying way to do this or some other way we can tackle this?
Tina, thanks so much for your question. Very much appreciated. And first of all, I share your pain. You know, without a doubt, the municipalities have been hard hit in the marketplace before even COVID came into play. I think there's a couple of things here. One is we're spending a lot of time with the insurers trying to develop additional capacity where in the past they may not have had the same level of interest because of the rate environment and a very soft environment. And now there's a little bit more interest. And so that applies not just to municipalities, but across the broader scheme. We're saying to our brokers, do not rely on what an insurer's appetite might have been 2 years ago, or even a year ago or 6 months ago, because that is constantly changing. The municipalities and a lot of other public entities, as you know, as a direct result of COVID, we have actually been involved with lobbying, if you would, and raising the issue to both the federal and provincial governments in order to consider a private-public partnership in order to be able to assist in economic recovery, so that on a go-forward basis, and rest assured, there will be some other type of pandemic that comes through, recognizing that the insurance industry cannot sustain those business interruption losses in particular. So we're very focused on that, as well as there are a number of other lobbying efforts within the insurance industry in Canada, with the IBC and a few other associations as well. So we share your pain on that. It isn't specific to municipalities. It is an area where we have got extreme focus on that right now, and we need to find a way to continue to expand that capital pool, which is challenging. So share your pain. Again, I do think there's probably some optimism, but we're going to have to lobby that together.
Thank you, Sarah. I appreciate that.
Lynn, Heather, do you have any additional comments?
No, I think Sarah has covered off a challenging market in a challenging space. I can share with our community of risk managers that your individual risk characteristics matter to the underwriters, and risk selection dominates the way insurers are thinking about an industry or a segment right now, and therefore putting forward your submission and your organization as best in class, demonstrated through risk management and risk control and even risk culture. I would just encourage you to put that forward, request meetings with your carriers. All of your brokers are going to be amenable to facilitating that, and tell your story. And it's interesting because we see major corporation, publicly traded D&O meetings as a matter of course, where 50 or 20 underwriters will get in a room together to listen to a CFO or an investor presentation. And I think sometimes we think of that as a unique set of circumstances, when I believe you would have underwriters available and willing to listen to a risk manager bring their risk forward. So I would say think about the risk characteristics first, and the differentiation, and then talk to your carriers and brokers about where they're seeing the losses. And we are seeing attritional fire losses in public entity business. So be proactive in the way you're responding to that in the market. I hope those hints are helpful, Tina.
Yes, thank you very much, Lynn. That is helpful. There's a couple of questions in the Q&A list. I'm happy to read them to you if you like. One question was, thanks for the presentation. How long will this hard market stay?
Well, I'll ask the speakers if they can pull out their crystal balls now.
I was going to say, I think we should start with Heather at the top of the house, where, as Heather described, that ILS trapped capital, because I think that actually drives some of the response. What's your crystal ball say, Heather, as we head into 1/1?
Well, it's interesting. I mean, the ILS is definitely one of the factors driving this, but that only makes up about 15% of the total capital. So it's not necessarily driving it all. I think that, I'd read a quote from a reinsurer the other day and talking about we've had a softening market for over 10 years and the pricing where it is now is less adequate than it was 10 years ago. So, hopefully longer than a year. But certainly it is going to be hard for at least a few years, I'm expecting. We're sort of, last year when the reinsurance rates weren't going up, we were sort of getting squeezed in the middle. The insurance rates for you folks on the risk side were certainly going up. Our retro rates were going up and we weren't getting any rate increase in the middle. So we weren't benefiting from the rate increases on the insurance side because we really rate reinsurance based on exposure. So so it's inadequate at the moment, and hopefully it lasts for more than 6 months.
Thanks, Heather. I'll maybe step in next. I think if we were guiding your budgeting for 2021, we would encourage you to be robust in your budgeting. You'll get individual data points from your brokers across a spectrum of insurers by line. But I think the economics matter. And we started with, we're in a recession. We have very, very low interest rates. And I think we can expect extremely low interest rates for a period of time, which means your carriers to stay afloat and to manage through that environment really need to target a 95 combined. And unfortunately, if you look at the MSA research results for the first half of 2020 in Canada and peel out the commercial carriers, we're sitting well above, as a collective group, 115 or 120% combined. So I would watch the signals from the economics of the market. Talk to your insurers and talk to your brokers about that guidance. But we would see much of the market dynamics that we're currently experiencing extending well through 2021. And Sarah, maybe you can help put all those pieces together and bring us home.
Okay, so I'm glad we started at the top with on the reinsurance side and then down onto the direct insurers and now onto the brokers. I think there's a couple of things. I mean, first of all, as I had said in my comments, this is now the 11th consecutive quarter of price increases, and I think certainly for the balance of 2020 and going into Q1 and probably Q2. Now that's my crystal ball. The other side of things is that without a doubt, because of profitability challenges with a number of the insurers, coupled with insurers are now starting to change their appetites in certain areas where they have historically not been interested in writing certain classes of business because of sustained very low premiums. There is now more of an appetite for that, and that is starting to change. And as brokers, that's exactly where we're pushing the markets to invite them, if you would, and assist them in creating additional capacity on that basis. So, I do see some optimism on that basis. Insurers who haven't traditionally been interested in doing so now saying, for the right risk, we will now take a look at that. So that's number one. The other thing that I'll say is that I referenced in my comments about going more broadly. We talked about Lloyd's and some of the challenges that they've had. But for multinational risks in particular in large risk management, we are finding capacity and insurers who are interested in other parts of the world in Canadian business that historically had not been. And so we spend a lot of time working with our hubs on a global basis to see what that interest level looks like. Remember that insurers are always looking for a spread of risk, and that includes a geographic spread of risk as well. And so, being able to access on a broader basis, you can often find additional capacity that way. And I do see some optimism. Again, we're not through the cat season yet. Canada was hit badly so far. Let's hope we don't get any ice storms coming through as we go into Q1. But I certainly do see that there are some insurers who are wanting to broaden their appetite.
Thank you. I think we've covered off that question very thoroughly. And you've given us some great insights as to what to expect in 2021 and potentially even beyond. The next question is, are insurers looking to risk share with governments to reduce the impact of the hard market during a recession? It's an interesting question. I'm not sure that our government is looking to do any risk sharing, but maybe Sarah and Lynn and Heather, you have some additional insights.
Yeah, I'll just kick that off, and then Lynn, I see you come off mute as well. I mean, I would say that what we've been focused on with the government, and it's not just with COVID, Marsh & McLennan Companies has been involved in a number of jurisdictions around the world to try and come up with some systemic issues. So whether or not that's flood, whether or not that's quake, to have some form of a risk sharing mechanism in place, or a risk funding mechanism. Certainly with respect to COVID-19, and future pandemics, we feel very strongly that there needs to be some form of partnership to be able to fund. The question becomes, do you pre-fund it or do you fund it at the time? But there needs to be a mechanism by which to do that. It's interesting that in some parts of the world where we've been having conversations on either the flood or terrorism is a good example, or on quake or other systemic issues, there are some governments who are looking to take a look on an aggregate basis at those sort of catastrophic risks, if you would, rather than focusing on any one in particular. But I would say that where the governments have been focused has not been on the hard quote unquote, the hard or hardening market, which is a profitability challenge. They're focused on more systemic issues that are going to be very specific to individual countries. Lynn, over to you.
Thanks, Sarah. I think that's hugely helpful. We actually differentiate between Nat Cat and pandemic. I think pandemic is a very unique global situation that is not as contained as a Nat Cat event from a geography or a time perspective. But I'm on the PASIC board, which is the insolvency fund of the P&C industry in Canada, and a tremendous amount of work with the federal and provincial levels of government, but joining with the IBC to really seek systemic financial backstop for earthquake in Canada. I think that is really the big one. And the industry works almost as a shared pool. So if a carrier were to become insolvent, the rest of the insurers come together and based on their market share would contribute to fund the claims and the payouts to see that wound down. And so we do reach systemic critical nature at a $30 billion earthquake. So that's the point of the tipping point for the industry in Canada. Prior to the global pandemic, I think the federal government was expressing some interest in working with the industry. And of course, the immediacy of what's happening today has sidelined some of those discussions, but we're going to continue to pursue at least the conversation, and the education is so important that we have ministers and decision makers in government that understand the critical issues. And someone said to me recently, what can we bring? We can bring math and modeling, and both are greatly helpful to trying to wrestle some of these issues.
Are there any additional comments?
No, I think the concern here is the hard market. And Lynn's right. I mean, the discussions that are going on are more so around the Nat Cat. I'm aware that there's discussions on the flood side as well. And, obviously flood is covered under commercial policies and only recently being covered under personal lines policies. And that's one, the ones that are most at risk can't get cover. And so there is, I believe, some discussions around that. But all of these things require really good modeling to be able to quantify the risks. And so flood modeling is only a recent new development in the Canadian market. So yeah, it's from the Nat Cat side that I'm sort of more involved in. But yeah.
The next question we have, and this one is I find very interesting, is that how are virtual marketing meetings going? And what is your advice to make them more impactful? I think the majority of us are spending a lot of our days on Zoom and Teams meetings. And so how, for anyone who is going into the renewal cycle and doing it virtually, any words of advice so that how we can make ourselves, differentiate ourselves from our competitors?
Yeah, why don't I kick that off, since we're, as the brokers, often the ones who are actually orchestrating those underwriting meetings. So I think there's a couple of things. First of all, I think for those risk managers and their teams who have spent time getting to know their underwriters over the last couple of years, I think the meetings are much easier, if you would, because at least you've got a commonality. You know the individuals, and it's a lot more personalized, which is hugely helpful. So for all of those times that we were saying, including during extended soft market, that those meetings are critical, I think now it really does come home to roost in terms of having those relationships, at least to be visually. The second thing that I will say is that it does depend on the way and the format of those meetings as well, and a lot of it depends on the coverage line in particular. Our preference would be to have smaller individual meetings, just like in person. Those tend to have more of an air of intimacy, if you would, and the ability to speak more freely, rather than having the Hollywood squares, as we call it, of 15, 20, 30 people on the line. The other thing that I'll say is that within whether or not you're using Teams or whether or not you're using Zoom or WebEx, take advantage of the way in which the features of those particular platforms can be used. So for example, for a Zoom meeting, which is one that I'm most familiar with, what we try and do is make sure that the client representatives can be seen on the screen, and so we're not showing 15 people or 12, so that you can actually concentrate on the individuals that are speaking. If a deck is being used, then make sure that you've got the screen, the slide that's being shown, and then just having the individual speaker in the smaller lens, so that you don't have all of the participants down the side. People are curious, right? So they're going to be scrolling up and down. We've all done it. If you provide people's photos, then that's going to distract them from the topic at hand, or the discussion at hand. So I do find that that's very helpful. There is something about you've either all got to be on the screen and participating that way, or almost not, because I think it's just like when we were in our offices and you've got people in conference room and then some people dialing in. Those who are dialing in almost always don't feel as though they're quite as in the meeting and able to offer up their comments, concerned about stepping over each other, that sort of thing. So I think it's all about trying to make sure that you're truly taking advantage of what are we trying to achieve here. The underwriters want to hear from the client. It needs to be very well facilitated, very well organized, take advantage of the technology, and above all, make sure that you're managing it, facilitate it to the time that is allowed as well, which is critical. So those are just my thoughts. It's not ideal, but in a lot of cases, it can actually be a very effective meeting. But again, those relationships help, and the way in which you organize it helps.
So Sarah, I would agree with all of that. The only thing I would add is have an agenda. Your brokers won't let you get in front of us without one, but also please assume that for your insurers, there are a lot of new people to the industry. There are a lot of new underwriters. We've certainly added a lot of professionals in 2020. So please don't assume that everyone knows your risk 100% or the history. Take a moment and tell us the story. I'm finding that the most impactful meetings are the client actually telling us this relationship goes back to this particular point in time, and here's been the evolution of the risk. And most importantly, baseline last year's renewal, here's what's changed. and here's why. And so please share that information with us. I agree, slides help. There's a great Harvard Business Review article about hosting virtual board meetings, which I'm really struggling with because there's a lot of slide content, and the advice is less is more. And so if you can give yourself 8 or 10 slides that go to the facts and tell the story and share your risk management journey, I think that's going to be a very compelling meeting because it's all around the conversation. So in complete agreement, Sarah.
Thank you. Those were very practical tools. And for those of us who are heading into renewals, I think that it will assist us as we go forward. I think we'll just end to keep with the time frame that we've got for questions, and really pleased with the questions that have come in. Why don't we end up with one more? And we won't, to all of our registrants, apologies that we can't answer all of your questions, but I'm going to end up with this last one for our panel. The day-to-day things we do in our industry has changed dramatically. We're having this conversation remotely now. As managers of large groups of people, what do you think will stay changed after the pandemic has ended, and how do you think change will impact the way we do our business? Can I start, Sarah, with that one, please?
Yeah, it's a great question. I mean, it's in a lot of ways, the way in which we are being forced to live our lives, both personal and professional, has got some extraordinary challenging things, but yet there are some silver linings, I think, as well. You know, one of the things that I think about from a personal perspective that I brought it, you know, to bring into business is that I think this has made us, and the way in which we have to work has made us all that much more empathetic as to what others are going through. And I think a little empathy in both personal and business lives is hugely helpful. And so I would hope that we're able to hold onto that. I think you know, the way in which we're communicating, while we may not like the nonstop Zoom, and it definitely has its disadvantages, but I think we've certainly seen that it has allowed us to communicate more regularly, and it has had the impact of being much more of a flat communication. And by flat, I mean just in terms of hierarchy, which I think again has been extraordinarily helpful. So you know, we've got a much broader geographic reach now to be able to include people in meetings who wouldn't normally be necessarily able to travel in for those meetings. And so you know, I think we're getting a much better cognitive diversity of thought and contribution, if you would, which is absolutely critical, I think, specifically in our industry. And I'm not meaning just the necessarily the gender or the ethnic diversity. I'm meaning a much broader thought process as well. And so that's one of the things that I think that we can absolutely continue, and we should continue to strive to do that, because that's going to be good for all of us, both personally as well as professionally.
Heather, can I turn it over to you, please?
Sure. I think, you know, the reinsurance community was very reliant on face-to-face negotiations. And I'm sure that's true across the whole insurance industry. And we really have had to figure out how to go digital and how to have these conversations face-to-face, but, you know, over Zoom. And some are better than others, for sure. And I still hear that some of the brokers are really hoping that we can be face-to-face for the renewal negotiations when it comes down to December. But honestly, I'm quite happy in my little bunker in my basement. And, you know, I think that might likely continue. And I think people are going to be more flexible in their work habits and more empathetic towards people's lives and what's going on in their lives. So I think that has been a real silver lining of this pandemic, and I hope at least that does continue going forward.
Absolutely support and agree with the comments that Sarah and Heather have made. A couple of things. What's changed? We can all work from home. We have proven it. We have not missed a beat as an industry. The connectivity has been right there. We have taught a lot of our veterans, new technology and new ways of working. And I think it has brought the community together. So that has been a real positive. I can't imagine being onboarded or joining a new organization in the midst of a global pandemic, but we've added 50 professionals to our firm remotely and electronically. And I'm encouraged but stunned at how smoothly and to Sarah's point, I reach out to all of those new hires. I make sure I'm connecting, and they are finding that they can grasp the culture of our organization through that process. So I think we're getting pretty creative in the way we engage with our team members. And then, I would just finally leave it. I echo Sarah's comments around diversity. I would leave it with the word empathy, which both Sarah and Heather employed. And as a senior leader, my understanding of the need for mental health benefits for every single one of my employees, regardless, whether it's grief or a young student who's concerned, or health, or aging parents, or young children, what we have had to manage through in the past 6 months has tested all of us in different ways. And if anything, that focus, and for us, it's Health and Wellness Month at AIG, that focus will not go away. And so the empathy will stay. The connectivity will expand, but we still look forward to getting back together to have lunch with all of you. So maybe I can leave it on that, Catherine.
Thank you very much. Heather, Sarah, Lynn, your responses to our open question and answer period are we gratefully appreciate them. We appreciate your honesty and your openness to respond to them. I think that the final comments that we have really nailed it with regards to what we're all experiencing, both in this hardening market, in this working from home situation. And we really appreciate the time that you've taken to put your presentations together and to be with us today. Thank you. I'll turn it back to the controller, please.